Welcome to the XFO Intelligence podcast. Today, we're exploring a defining moment in global finance, the Great Monetary Reconfiguration, navigating the new global financial order. It's May 2026, and we're witnessing the most significant transformation in the world's financial architecture since Bretton Woods. Policymakers, investors, and institutions are adapting to a more complex, multipolar monetary landscape. Let's dive in. First, let's clarify. The global monetary system is not collapsing. It's fundamentally reconfiguring. After 8 decades of US dollar dominance, pressure from fiscal imbalances, geopolitical fragmentation, and technological innovation is gradually shifting financial power toward a pluralistic architecture. By mid-2027, we expect the dollar's share of global reserves to settle around 54%. Central bank gold holdings to exceed 11%, and regulated stablecoins to facilitate over $1.5 trillion in annual cross-border settlement. This is not a simple replacement of the dollar by the renminbi or another currency. Instead, context-specific settlement networks are evolving. Capital markets still favor the dollar, while commodity trade increasingly accommodates local currency or gold-backed arrangements. Digital bridges are forming to ease friction between previously incompatible systems. So what's happening to the dollar's dominance? The US dollar remains the primary reserve currency, thanks to deep capital markets, institutional credibility, and a robust financial security architecture. Yet behind this strength, there's a slow erosion. Dollars now compose roughly 57% of global foreign reserves, down from 71% 2 decades ago. Why? Central banks are diversifying to hedge against risks, including the twin deficit challenge, reliance on foreign capital inflows, and the extensive use of financial sanctions, which incentivize alternative systems. The global debt overhang, now at a staggering $323 trillion, further complicates this picture. For emerging markets, 2/3 of external debt is dollar-denominated, leaving them vulnerable when US rates rise or the dollar strengthens. Every 100 basis point increase in global rates adds about $400 billion to emerging economy debt servicing costs, and many developing nations face large refinancing needs within the next 2 years. Let's turn to oil money. The petrodollar system, where oil is priced in dollars, is evolving. The UAE's recent exit from OPEC allows more flexible bilateral energy agreements, including some yuan-denominated sales. BRICS plus nations are exploring local currency and gold-linked settlements. The monopoly of the petrodollar isn't ending overnight, but a more pluralistic landscape is emerging, driven by geopolitical shifts and energy security strategies. Gold is back at the center. 43% of central banks plan to increase gold reserves this year, up from 29% just 2 years ago. Why this resurgence? Gold is a hedge against fiscal and sanctions-related risks. It can't be frozen, and it's a store of value that isn't tied to any single government's fiscal position. Central banks are set to purchase around 850 tons of gold this year, making it not just a passive reserve, but an active hedging and settlement tool for times of financial stress. Digital dollars and regulated stablecoins are also shaping the future. The US has chosen to regulate dollar-backed stablecoins instead of issuing a central bank digital currency. By mid-2027, these stablecoins could facilitate $1.5 trillion in cross-border settlement. Yet challenges remain: issuer concentration, regulatory differences across borders, and interoperability gaps. Stablecoins are not just a technological phenomenon. They're also a geopolitical instrument that could either reinforce or fragment dollar influence. How is China responding? With a careful, incremental approach to renminbi internationalization. About 30% of China's trade is now settled in renminbi, and its cross-border interbank payment system, CIPS, is expanding. Yuan-denominated commodity trades are growing, but capital controls, a managed exchange rate, and trust-related constraints limit the renminbi's global role in the near term. Geopolitics matters too. The competition between great powers shapes financial infrastructure. Middle powers are hedging their bets, and regional instability triggers shifts in monetary strategies. Looking ahead to 2027, we anticipate managed pluralism, a functional but increasingly polycentric global monetary system, with multiple hubs and more context-specific settlement networks. The dollar's reserve share will likely dip to around 54%, with stablecoins continuing to grow and gold playing a larger role in reserves. Systemic fragility may increase, but so will redundancy as new routes and settlement pathways emerge. What are the strategic implications? Policymakers must focus on fiscal credibility, careful use of sanctions, and investing in interoperability standards. Central banks will need to treat reserve diversification as a portfolio exercise and prepare for gold and stablecoin oversight. Financial institutions must build treasury systems that can route across multiple layers. Technology providers must design flexible, compliance-centered systems. In short, the road ahead is about building bridges in a fragmenting world. The future of the global monetary order isn't about one currency dominating. It's about a network of networks. Those who navigate this reality, who invest in interoperability, transparency, and resilience, will be best positioned to thrive. Thanks for tuning in to this episode of the XFO Intelligence podcast. We've only scratched the surface, and we'd love to hear your thoughts. If you found this valuable, please like, share, and subscribe to our channel. And if you have feedback or questions, email us at xfointelligence@gmail.com. We look forward to exploring more with you.